the strategy is sound. I think it is, on the real estate fundamental side, it's just sticking to that stated strategy that we've had, which is rolling out our development pipeline of prime logistics and logistics parks. So that pipeline's currently sitting at a cost of about 5 billion with another 5 billion to go. So it's continually driving that pipeline and looking to recycle some of our smaller assets. We've got 301 buildings, and I think we would like fewer, larger, better quality buildings. So it's sticking to that strategy on our direct property portfolio in South Africa of 30 billion. And then, also we've got obviously 20 billion roughly in listed securities. The biggest by far is our 24% of Nepi Rockcastle, which is a fantastic business headquartered in Bucharest in Romania. And it really is a great management team there, and sound, top quality retail assets in Central and Eastern Europe. So I think that's our core listed holding. And then we still own 9.6% of Resilient and 21% of Lighthouse Capital. And I think those are non-core. We're not in a rush to sell them, but I think we would like to exit those investments over time. And really sticking to that strategy, and then also, I think sticking to the stated intention of, becoming more focused on transparency. Fortress is 10 years old this year. In October this year, it would have been listed for 10 years, so a lot of the directors will come up for rotation. We appointed 3 new non-executives last year, as well as, a complete change to the executive team. So we have had a lot of board changes, and I think it's also just making sure everybody's comfortable and the board sets a strategic direction for the company. And it's really, I think, making sure that we stick to that plan. And I think it's a sound plan, and fortunately, under the leadership since listing of Mark Stevens, he's been very disciplined and instilled a lot of discipline in the company and in the sales team of disposing of a lot of the non-core properties. So that puts us in a fantastic position, I think, to grow the overall distribution and to grow the distribution of the B unit going forward.
Let's talk about some of those. But firstly, in terms of your pipeline, how are you funding the pipeline?
So the pipeline is funded primarily by recycling the capital from the sales. So if we look back in FY17, we sold and transferred about 1.7 billion of property. In FY18, we sold and transferred about another 1.7 billion of property. And I think FY19 this year, we have done about 500 million, and we should land up between 1 and 1.2 billion for this year, which roughly matches the capital that we deploy in the logistics development. So, and that's really just a fantastic model for us. It's just recycling the capital, and over time, given the growth of the logistics properties and the static nature of the debt, that should reduce the loan to value ratio as we roll out that pipeline. Because
that was a big concern, your debt book, and Moody's came out with a rating as well, and I wanted to get your sense of how you're managing that.
So Moody's did put us on negative watch. So we're still currently investment grade rated by Moody's, but negative watch. It wasn't so much the loan to value ratio, which is sub 35%, which they require for investment grade borrowers. We're sitting at approximately 32%. So they're comfortable with that. I think it's really a bit of a change in rating methodology in terms of the liquidity and how they would like to see committed undrawn facilities or cash on call to fund all of the cash outflows, including debt repayments over the next 12 months, which means as an investment grade borrower, you would need significant facilities uncommitted from the banks, or alternatively cash on call. And I think some of that is a business and a commercial decision to say, well, it would cost us a lot more to maintain that rating, and perhaps it can be sub-economic sometimes to do that and to maintain the investment grade rating by Moody's. GCR, another rating agency, has recently affirmed our rating at investment grade, so we're comfortable that they are still looking at us in the same way and still maintaining that investment grade rating. So
you're not prioritizing making sure that you're still Moody's investment grade. You're prioritizing the business.
Yeah, look, it's obviously a balance, but to the extent that there are large obstacles in terms of key financing decisions and business strategy to maintain an investment grade rating, I think we would need to look at that and balance that against, what are the shareholders paying for this and what are the shareholder returns, and is it absolutely required? I think when we look at the credit of Fortress, we have refinanced a lot of debt with the banks at rates at credit margins that we actually found more attractive than we were expecting. We've recently refinanced 1.4 billion with Nedbank. End of last year was 2.2 billion with RMB. So I think we're not concerned about the credit of the business, and the banks are completely comfortable. To the extent that the rating agency has a different view, I think that is one of many inputs that the debt capital markets and our bond investors look at. I think they also have big credit teams and do their own analysis themselves.
So let's look at the business. Your logistics portfolio is doing really well for you, but your offices portfolio has been quite a drag on the business.
Sure.
How soon before you just sell out that portfolio completely?
Look, I guess our preference would be as soon as possible, but with the caveat that we don't want to do that at significant discounts to what we perceive as our fair value on that office portfolio. You would have seen that there's a lot of office vacancies in the market, a lot of sort of B and A grade space that's vacant in Sandton. So that market is structurally oversupplied, and I think it is something that we don't see as core. It's roughly 2.4 billion that we've got in our office portfolio, but fortunately we have been selling the vacant offices, which are often easier to sell to the likes of owner-occupiers rather than the investor market. So I think we're left with a reasonable quality of offices in that portfolio, and we still maintain that to exit at the best price, you're going to be selling these things one by one. So that process continues, and our sales team and our office management team are working closely to make sure that all the tenanting decisions are done with an exit in mind.
What's the timeline?
I think we'd like to do that over the next 3 years, and I think that's achievable.